The first reversal pattern we'll discuss is the reversal day. The reversal day occurs at the top or the bottom of a trend. A top reversal day is formed when the prices form a new high at the top but closes towards the low of the day or lower than the previous day's closing. A bottom reversal day would form a new low at the lows of the market but close above the opening towards the high of the day or higher than the previous day's close. Now these are buying and selling climaxes. By this we mean that on a top reversal day, the buying has saturated, and on a bottom reversal day, the selling has saturated. Now in candlestick charting, these are also called dojis, and there are various kinds of dojis in candlestick charting which we could look at later on. The wider the range, the heavier the volume, the more significant is the signal as a reversal pattern. If the high and the low exceed the high and the low of the previous day, the reversal day is also called an outside day and is construed as more significant than a normal reversal day. The reversal days mark an absence of buying and selling and signifies that a high or low has been seen. Sometimes markets also form two-day reversal patterns when prices close near the high, but the next day the market closes at a low. These patterns can be seen on daily, weekly, monthly charts, and the higher the timeline, the higher the significance. So some key points to remember for reversal patterns. First, we need to identify the trend we are looking at for a reversal or a continuation. We next need to check if any major trend line has been broken. This does not necessarily mean that a breaking of a trend line signals a reversal. As we have seen before, it could signal that the trend line was too steep and now it's moving to a more sustainable pace. A sideways consolidation could also signal a pause in the trend rather than a reversal. If the consolidation phase is large, its significance is larger. The amount of time it takes to build the pattern, the size of the pattern, the volatility of the prices all add to the significance of the phase and higher the potential for the price move post the breakout. As we have seen that the target price is measured by the volatility of the price action. In reversals, it's generally seen that topping patterns are shorter in duration and much more volatile than bottom formations. This is because prices fall much faster than they rise. Psychologically, it's much easier for a trader to sell or be square rather than to be long. Especially at market tops, it's very hard to purchase when the market has already moved significantly and the prices are very high. Players always wait for a correction before they start buying. Therefore, making money on the short side is faster than making money when long. Now, volume is another important factor during breakouts. If the volumes are not high during a breakout, the pattern is questionable. We briefly look at double tops and double bottoms. A double top and bottom is very commonly found in daily, weekly charts. Let's quickly see how these are formed. In an uptrend, a double top has said to have been formed when two peaks are formed roughly at the same level. Volumes are thin on the move to the second peak, but high on the move down to the closing. The trough now forms a resistance when the prices move up. The same logic applies to the double bottom. Next, we will look at the head and shoulders reversal pattern, which is one of the most popular patterns in technical analysis.